Good evening. Miguel, you're online?
Hi, Sam. I can hear you. You're loud and clear.
Okay, so you're gonna give me the controls?
Yeah, I made you host, so you should be
Okay,
able to do
awesome.
everything.
Thank you. Good evening, everyone. We're gonna start in just a few minutes. We'll give 5 minutes for everyone to get in.
Have to be on the same level. The problem is you married shrine regime. Now you married native regime. You're looking for a much better class of man, huh?
Good evening, everyone. I hope everyone is doing good today.
Good evening.
So,
Good evening.
Good evening. So I don't know if everyone read the cases. I'm hoping people read it. I'll glance them. So Unit 6 deals with situations and cases that we're going to review, and there are going to be some takeaways. I'm going to refer to the questions that they already have in each section to talk about it a little bit, and I am looking for engagement by everyone in the discussion. So please feel free. Let me go to my presentation. Okay, great. So today, what I want to do is we're going to talk about governance, risk, and compliance, and just an overview to give an idea as to why we are talking about these cases. And then we're going to look at some of the cases. There are about, I think, in this unit, about 6. So we're going to try and get through as many of them as possible. And then we're going to talk about, we're going to summarize some of the things that we could glean from looking at each of these cases. So some of these are going to be familiar. You might have covered them already in your studies or used them in assignments you have done. I would say to all of you, because I know there's another assignment that is coming up, it's important to pay attention to the cases. They provide valuable information that could support whatever you are proposing, especially recommendations to the board, to persons in authority. When you're making recommendations, when you could refer to something to say this has happened before, these were the consequences, hence why it might be good to avoid certain actions. So cases provide support, cases provide context and background. So it is important to look at cases, refer to them, rely on them to glean important information. And if you have questions along the way, please feel free, you can interrupt me. So the first section of this unit just talks about having a centralized governance, risk, and compliance unit, right? And you know why this might be important and why you would want to do it. So I'll just ask the question first off, do you think it's a benefit to have this function centralized in the organization or a company? And when I say centralized, not you have different units doing different things than just having one central unit charged with the responsibility of governance, risk, and compliance. Which one you think is better? Decentralized or centralized?
I think centralized is good because if one unit sets a policy or sets a tone, then everything can kind of fall in place and be on the same page, so to speak, as opposed to everyone doing different things, working towards a different goal. Some things may conflict and not be in line.
Exactly. So You want to have focus, you want clarity in what your mission, vision, objectives are, and also you want accountability. So if something goes wrong, then who is responsible ultimately? So in large organizations, you may have activities that might be decentralized, but in terms of responsibility and making sure the tone of what your governance risk compliance should be about, having that centralized is definitely a huge benefit. So when we think about centralizing governance, risk, and compliance and making that investment to do so, there are areas that will impact and that will be needed. So you have to think about policies and procedures, as well as your IT systems and processes. As I mentioned already, responsibility and accountability and the lines of communication. Everyone needs to know where the buck stops, who is responsible, where do I go for the final answer. So as well as in policies and procedures, you need that to reflect what is the culture going to be, what is the governance, risk, and compliance framework for that organization. And everything should flow from that. So it's important to understand why it's important. It's also important to be able to demonstrate to management why they should make the investment in it. Some companies don't necessarily view it as valuable, but it's important for all of you, if you're involved in compliance or involved in these areas, advocate for investment to be made to make this a core function and to have these activities and responsibilities centralized. So why do we want to do this? We want standardization, as was already mentioned. You don't want different units doing different things. So we know we'll have a standardized approach. If you open an account, if you do certain activities, it'll be done exactly the same way because it's coming from one central area. This is how we do this. And there are no other approaches. This has been agreed. It has been tested, vetted, etc. And this is in policy. This is the approach we will take. No mixed messages. So as it says here, clarity of approach. We know we are clear. All stakeholders know what the role of GRC is, and they understand what the function is responsible for and who is responsible, when they're responsible, etc. And then our efforts could be focused. So we don't need to be all over the place. We know this is our role. This is our lane. This is where we add value to the entity. And it will, if we follow the first three, it'll improve the credibility of the function. People in some organizations, there's attention placed on GRC, and some and others not very much. And one of the reasons is that the key stakeholders, executive levels, the board, doesn't consider it to be credible, doesn't consider it to add value, not respected. So in an effort to definitely increase credibility of the function, it is important to make sure our efforts are focused. We know what our approach will be. We have a standardized approach across all functions, across all units, and we know what is expected. So understanding what we do, where we're going, we're gonna look at some cases because these, I believe, amplify the need for a good governance structure, assessment of risk, and where compliance and the compliance function is so critical in organizations. If it's absent, things could fall through the cracks. You lose important oversight, and that second line of defense is gone in terms of risk compliance. Okay, so the first case we're looking at in your material is Lehman Brothers. So just some facts about Lehman. It was founded in 1850, so definitely this firm, this investment bank was around for a long time. They weren't, in the last 20 years, even 30 years. They are a significant entity, a lot of history, tradition, and they grew since their being founded into an international financial services powerhouse, as it says here. So during the financial crisis, Lehman, and before Lehman fell, it was actually the fourth largest investment bank in the United States. So definitely significant when you think of the US market. So in 2003, and I highlight the dates because in compliance, in governance, I would say dates matter because things happen. And I'll say throughout all the cases, it's important to focus on dates. And even when you do your assignment, make sure you consider dates. Regulation happens after an event. So when you follow dates, you'll notice that whenever there's a disruption, whenever there's an event in the market, the regulator, other government entities tend to respond with laws, regulations to combat whatever the negative consequences of a crash, of bad behavior in the market. You normally find that is when legislation, regulation happens. So in 2003 and 4, Lehman acquired 5 US mortgage lenders, right? And this is where the story began with the subprime lending. And if you notice what it says here, they specialize in self-certification mortgages, right? And these loans are made without full customer documentation and disclosure. And if you self-certify, that means you don't have any oversight, so no regulation. So at that time, there was very little regulation around this. So basically, you could get away with writing a mortgage and you don't need that much information even about your client. And they didn't just purchase one lender, they acquired 5 lenders. And so for the period following 2005 to 7, they recorded record profits. On their board, at the same time as this was going on, they had 10 executive directors. Half of them were over 70, and 2 were over 80 years old. So, that matters to the extent of the question being, how involved would they be in, decision-making of this entity? How aware would they be of new trends and changes in the market? They would have to be persons who are definitely actively involved if they wanted to be effective. When you think about someone in their 70s or 80s, you don't see this person attending a bunch of meetings, looking over a lot of data, different type of information. So that matters as well. So that was Lehman at that time. So the crack started in late 2007 when the credit crisis started to deepen. And Lehman's portfolio actually got up to 85 billion. And they leveraged 4 times their shareholders' equity. So if you leverage 4 times, if everyone came and knocked on your door and said, I want to cash in right now, you do not have enough, not nearly, not even half. So this is 4 times you'll be in the hole. In March 2008, their competitor Bear Stearns collapsed, right? And this impacted Lehman because when a competitor collapses of significance, then the market gets concerned because they are wondering who's next. And after that, if we follow the date, so that's March 2008. So following from that, the company's credit rating was downgraded and customers started leaving the company. By June, they announced a loss of 2.8 billion. And then in September, the value of their stock fell by 77% in 1 week. They couldn't sell parts of their business, they tried. And by Q3, losses of 3.9 billion were announced. So within 1 quarter, so from Q2 to Q3, they tacked on another 1.1 billion in loss. And then September 15, they just declared bankruptcy. Now, the person who was chairman, Fuld, he was chairman of the board, chairman of the executive committee, and the CEO. And he had a compensation package that amounted to 485 million between 2000 and 2007. So the first thing I wanted to ask of the class, you know, you watch this free fall happening from 2007, 2008, and this person is making 485 million. What do you think the board was thinking at this point? Do you think concern?
The board was just basically looking out for itself. It was just simply overcompensating themselves. They knew the loss was coming.
So the questions you actually have in your material, and I thought they were good questions, was why do you think the directors didn't understand the crisis the firm was in? Because they could have reacted sooner. I mean, once the credit crisis started happening, you know, if I go back to the previous slide, 2007, the credit crisis deepened. It wasn't at the beginning, it was deepening. They didn't actually react to start selling any parts of their company until 2008, and that's September. So they could have taken steps from 2007 to say, what do we need to do to start preventing any losses, potential losses that we potentially could have, given that we have this credit crisis going on in our industry. It hasn't impacted us yet. Well, at least we don't know, or we're not sure, but shouldn't they have done something in 2007 or understood that, okay, there's a crisis that might be impacting their entity as well, given that they were the largest?
I assume they probably weren't involved or wasn't advised.
So, so when they mentioned the age, that mattered because if you are 70 or 80 years old, right? How involved do you think you would be involved in the market? Other than you may be an investor yourself, but do you think you would be attending seminars all the time, getting training as a board member? Probably not. So this is the reason why when you see all of the regulations now, even in our community around directorship, why there's an emphasis on having a certain complement on the board, having persons who are qualified in certain areas of expertise, so that when these things happen, you have people who can speak up and say, no, 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 because they are representing the shareholders. So in our regulations, for certain in central bank and Securities Commission, across all the regulators, at least in the Bahamas, board complement matters. You actually cannot be approved to be on a board without central bank giving approval. And because of regulations that are in place as well, you need in most cases to have an independent director. If you're a financial institution, it is expected that you will have one or more people with a financial background, someone with a background in finance, to give feedback, to have the understanding. There's also the expectation that you will have an audit committee that would meet and review some of these matters that come up. But again, this company could have been producing all the reports, and if you read the case, there were warnings given to the senior people, but the question is, did they understand? So in our local context as well, I'll give you some perspective, because I worked as an auditor maybe 20 something years ago when we did audits and we looked at boards, and you look at the board complement. A lot of companies used to put persons on board. Oh, this is my friend, I'm going to put them on the board. We play golf together, XYZ. There was no, this was before the regulation, so there was no thought to think about, well, do they have this type of background? Could they give challenge? Are they someone going to question something that is not right? So wasn't a lot of emphasis on that as well, in a lot of trusts, and I'm not sure how many people in the class work for bank and trust or private banks. It was this thing where people they take the staff, and so many people would be on these, what they call nominee companies as directors, etc. And you ask the person, okay, you're a director of this company, what does the company do? And they have no idea, they just sign it. So because of what has happened in the environment, this has brought a lot of focus to one's role as a director, and understanding that you do have responsibility. There's an expectation that you should be able to understand what is happening, that you should be able to, represent the shareholders when, matters come up that threaten their interests. So the second question here, where were the external auditors? So what do you think happened there? Do you think they have responsibility?
External auditors, I think they do. I know like in the past, sometimes we used to have external auditors that would be auditing for very long periods of time, and they would get very comfortable and relaxed. So they wouldn't do full audits like you would expect them to do.
Anyone else have any comments? That is actually, that's a good observation and probably very accurate. Anyone else have perspective on that? So being an external auditor and work before all those regulations, we used to be able to go to lunch with the client. Clients used to give us gifts sometimes. I recall there were times when the clients would invite us like to their Christmas party, to whatever functions. We can't do any of that now at all. If a client even gives us any type of gift, we have to disclose it. So it is very difficult to be independent if you are familiar. So even the accounting profession was impacted by the financial crisis because it highlighted where the external auditors needed to be independent. As you could see in question 4, it talks about, could the board's culture have been driven by feelings of invincibility after 150 years of success? And that could happen, you know, over time. The view is that you are too big to fail, that how could you challenge such a, you know, revered institution? That's like going, you know, when people use the expression going to the bank, like they cannot fail, but they did. And it's important to be aware that even the longest standing, some of the longest standing and most reputable could fail if they don't have systems in place to protect the entity. So one of the gatekeepers are, one of the main gatekeepers are the compliance, risk, and the governance structure itself. So, and I highlight this for when you are doing your cases, it's important to make sure that there's an understanding of what the director's role is. Is there independence with regard to the external auditors, or are they comfortable? And if the company has been in existence a long time, there's a high likelihood, if they haven't changed board directors, that this could be a problem. So in the UK has corporate governance guidelines that they issued in 2018. And the guidelines advocate rotation of board members as well. It speaks about remuneration, how they are paid. It speaks about qualifications. It speaks about having assessments done on your performance as a board member. So today it's very rigorous, the expectations if you decide to serve on a board, and expectations as to, you know, how much reliance is going to be placed on, you know, your role and the risk that's associated with that. Some boards in the Bahamas require now that you have to do board training. So that you as a board member understand your role, understand the risks, understand how you fit into the governance framework. I just completed training, I think it was 2 days ago, for an entity where I serve on the board, and I had to do the training. So the culture has changed, environment has changed. Not all entities have gotten a memo, but it's something that you need to think about. So some of the observations that can be made from the Lehman case was that that were made based on some analysis that was done, that there was no investigation by the independent directors. So everyone is aware of what the independent or who the independent director is or the function. Yes, no, maybe so.
No, I'm not too sure about the rules of it.
Okay. So an independent director is a director that is appointed to the board that is not involved in the operations, involved in any activities of the entity. And really, you shouldn't have any material contracts or any business dealings with the entity either. So you should be someone basically coming off the street with qualifications, walking into this business and know, you are receiving no benefit of any kind other than remuneration as a director, but you should not be involved in the business. So technically you shouldn't really know the people who are in the management, et cetera. You come to the board to give fresh perspective, a different insight based on your expertise and knowledge. So when the assessment is made, whether you qualify, one of the main criteria is whether you are involved in the business, whether you have any contracts with the business, because if you do, you cannot be an independent director. And so the expectation is this person would also be strong enough to give challenge at the board level. So if they see something that's not right, they could say, they would be in a position to say, no, this don't make sense to me. You need to explain it. Because if everyone on the board is involved in the business in some way, shape, or form in the day-to-day, then there's a less likelihood to go against the flow. And that independent director has no incentive, no reason to go with the flow. At least shouldn't. So if they see something odd, they should be the one that above everyone else should be speaking up and saying, no, 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 this is not right. Okay. And I think all the regulators in the Bahamas now require that there be at least one independent director on boards. And that person has to be identified as the independent director. And that came about with all of these crises and, reviewing our guidelines and expectations. So this is one of the things that came into being to improve corporate governance in the Bahamas. So that is the expectation, especially on significant entities. So you need to have an independent. Some companies have more than one, but you should have at least one. So the other observation that there was no special study by the board's finance and risk committee. So significant entities, this entity, as we understood, was one of the fourth largest in its prime in the United States. You would expect that it would have a robust governance structure and there would be a board committee specifically for finance and risk, right? That could have said a financial crisis is happening. How are you, management, how are you responding to this crisis? What are you doing? That's what the board members should have said. They could have asked for the executive or management to go back and explain to them what will be their approach, do a study, give us a summary of, what are you going to do? So you'll notice that I know in the course of your study, some of the cases that they give you follow the pattern of you have to advise management, you have to make recommendations. It could be management, it could be the board, and this is where it comes from. that when things are not right, the board should be requiring some sort of additional work to be done to ensure that the entity is protected. And then the last observation was there was no call for capital injection. If you're leveraged 4 times your shareholders' equity, so that means that you have borrowed 4 times the value of the asset you actually have or your net worth, you need some cash. Because if everybody knock on the door and ask for their cash, you're gonna be in trouble. And they never recognized that they were not properly capitalized. So hence you notice that, or you should be aware from your studies, that central bank has capital adequacy requirements now because of issues like this. So they review on a regular basis. Entities are required to report, I believe it's quarterly, their capital position. And it's not just good enough to say, okay, we have this amount of assets. You have to say the quality, you have to say the type. So you can have assets that are locked up in real estate because you cannot convert that to cash easily. You have to have a certain amount that's liquid. And if you have capital, you need to say how much is common stock, preferred, whatever the composition. So our regulatory framework has definitely been impacted by examples of this where banks failed because of the financial crisis. And out of that, some of the lessons learned were we need to have better regulations around and systems around appointment of directors, boards, if they are operating the way they should in terms of good governance. They should have committees that are active, that are performing as expected. And then lastly, the capital requirements. We should have enough capital to support our business and not be in a state where we have the risk of bankruptcy, which this entity ended up failing. I don't know if anyone has any questions or observations relating to this. Does anyone in the class serve on a board? Someone, I think, has to mute. They have a lot of static coming through. Okay. Can't go too far. So, Feud, this was the chairman. He gave his views as to why Lehman collapsed. He blamed it on the market, on the buyers, on the client's lack of confidence, credit agencies, credit default swaps, other destabilizing factors. So he never said it was poor management. He never said it was lack of leadership. He never said it was poor governance. He blamed it on more the external environment and what was happening outside of Lehman. Do you think that he should assume accountability for the failure?
I think that he didn't assume any type of accountability. I think it's a combination of poor leadership, as well as the what was happening with the market. I think once proper controls are in place, once a proper assessment is being done, when you see changes in the market, I think that you will be able to counteract, and you will be able to ensure that the company doesn't suffer a significant failure like what happened with the Lehman Company. So I think what they're doing is
I
actually
believe he should have accounted for his failures in terms of, but he probably didn't do it because at the time the culture probably didn't allow for it or didn't compensate for it. The culture probably was more about casting blame elsewhere as opposed to putting it on yourself. Perhaps even policies weren't in place or wasn't in place to put the accountability on the individuals who were actually working.
Do you think that is happening here in the Bahamas with our mortgages and loans that are happening right now? You think the banks are losing money because people lost their jobs, or do you think they're losing money because they had bad loans on the book?
Can we say both?
See, because it's the same situation.
I think it's both reasons.
You know, because you only need a downturn in the economy, something happens and people can't pay. But if you have a loan that makes sense, right, or a mortgage that makes sense, you do have something to hold on to. But they lent money. They bought these mortgage companies that didn't have proper due diligence in place. So basically they lent to people who might not have been credit worthy. You don't know if they did proper valuations on the homes that they had mortgages for. If you dig deeper into a lot of those cases, you'll find out that a lot of the homes were overvalued and money was lent on that basis. And so at some point, you know, the chickens are going to come home to roost. So you have one downturn in the economy, someone can't pay, and there's a domino effect of I can't pay this, my neighbor can't pay, they've lost their job. Then someone could say, okay, it's because of job loss or it's because we have poor practices. Should that person have gotten a mortgage to begin with?
Yes.
See? So that's why things like this are important, not just from the point of view that, oh, this, you know, this credit crisis happened. This credit crisis could happen because of COVID. So we take a current example right now that Atlantis laid off 700 employees. Those people have loans, they have mortgages. Is the banks going to survive? Did they have good governance?
I'm sure the bank's going to take the money out that is owed to them.
Thank you.
Yeah.
I'm going to be factual. That's what they're doing.
Okay. But is that right? I mean, they're doing that because why? The loans themselves, were they good loans? We're going to have people who are in distress, right? Because there's a ripple effect. So this is where, when you look at blame and you look at who should be accountable and go into the root cause, you have to understand why did this happen? Like, why did this is a reputable company. Suppose they were the one that says, no, we're not going to do those type of loans. they'd still be standing. There are banks that didn't suffer at all. At all, because they took a decision that they're not going to do certain types of loans. And they were deemed conservative. And they're too conservative, but they survived. You know, so this is where, when you look at these cases, it's important to think about, you know, yes, there are things that happen in the market, but there's a reason why it happened in the market. The market should be able to sustain certain shocks. It shouldn't be so wide, the impact that it caused such, you know, a large institution to fall, but it did. So hence the question here, the real reason that Lehman Brothers was allowed to fail. So the US didn't bail out Lehman, right? They didn't give them a bailout package. And Lehman actually, when you dig deeper into the case, before they actually failed, they actually had opportunities to sell. But they were so, I would use the word arrogant. They were so arrogant, they didn't think that, they thought that they were too big to fail. Oh no, we couldn't go down, but they did. So one of the things that came out of that whole situation was the fact that we had a new act put in place in the US, the Dodd-Frank Act. And one of the things that it did was, it made provision that if an entity was gonna liquidate or fail, there was a way that this would be done to minimize loss to all the stakeholders. So you have employees, you have the market, you have customers, everyone is impacted when a large entity like this fails. And basically, the purpose is to ensure that a failure, if it's gonna happen, there's a way to do it that doesn't really hurt the market. And any pain that's experienced is minimized. And in the Bahamas, we also have this in place where there are triggers and points for when the regulator can come in. They can suspend a part of your business if they deem that you are non-compliant or that you could cause harm to the market. They could stop you from doing certain type of services. So if the central bank came in, I think they did this to Bank of the Bahamas, where they said, okay, you cannot do this particular activity for a period of time until you bring it in order, right? So now there are mechanisms in place to ensure that banks remain stable. You don't have such a large institution failing. And it was, as I noted here, the FDIC, which is the Federal Depository, they concluded that, you know, even the regulators could have acted more quickly to, you know, in an effort to preserve the asset value and structure a transaction to sell Lehman's valuable operations to buyers, right? And that what that would have done was ensure that you still have stability in the market, right? So when if you just allow a bank to fail, that means it just falls apart. Whatever happens, happens, but there's a way to do it that could, like I said, minimize the impact on the market. You could preserve some jobs. You could preserve interests of shareholders and creditors and taxpayers, because all these people have to bear the loss when a company fails. They're always losers. And oftentimes the losers are the people who have the least amount of recourse, right? So that was one of the things that came out of Lehman's failure, is that we have a definition of entities that I think I don't know if you have covered it yet in your material, SFS, significant financial institutions. So SFIs. And if you are designated one of those, you have enhanced regulatory supervision over you. So in our community, without looking at anyone's records, anything, I could tell you the ones, any bank that could destabilize our market if they fail would be in that category. So definitely bank would be in that category. Could also be there because it's significant to the market, shareholding as well. Maybe FCIB, right? So those entities, you don't want them to fail. And if they have to fail, the regulator is going to take measures to make sure that it minimizes whatever the consequences of a failure, the impact to the market will be minimized. Any questions on that or comments or commentary? So the next case we have is Royal Bank of Scotland. So here we are focusing on, or the focus is on remuneration, the culture, as well as values and governance. So the last case we looked at, Lehman, focus there was on if you're too big to fail, and why people sometimes get entrenched into the idea if you've been around a long time, you cannot fail. Because sometimes people think that, but you can. So Royal Bank of Scotland, it was founded in 1727. So this is even older than Lehman. And connected clearly to the royal family. It collapsed. And the UK government, the British government, ended up owning 82% of the shares of the company. They bailed them out. So this is a bailout situation. So before the collapse, which happened in 2008, so this is around the same time as Lehman. Lehman collapsed September 2008. So Royal Bank of Scotland collapsed at around the same time due to the same situation, subprime lending. And at that time, they were the world's largest bank. So 1.9 trillion in assets and 1.8 trillion in liabilities. So many times over our own national debt, this bank's assets stood. And the person who was at the helm, Fred Goodwin, he was there for this period of growth and acquisition. So he was a proponent of buying up other institutions. So notice the similarities with Lehman. Lehman bought 5 mortgage lenders, right? In the case of Royal Bank of Scotland, they bought ABN AMRO, Dutch bank, right? And at the time, that particular institution, ABN AMRO, was, as it noted here, was burdened with the same subprime debt, right? And in the end, it proved that this acquisition was really one of the core reasons for the downfall of Royal Bank of Scotland. So again, you have an established institution, long history, consistent growth, stability, and decision-making, right? To make a decision to acquire a bank or another entity happens at the board level. It will not happen at the lower levels. It definitely happens at the board level. And if you're acquiring an institution, you should be doing due diligence. You should be doing adequate investigation, etc. So anyway, in 2009, The highest loss ever was recorded by a UK company of 24 billion pounds. Okay. And the UK government had to spend 37 billion pounds to bail out this institution. And then another 325 billion to guarantee service guarantor against this toxic debt. So just think about that. You have the government who decided to step in and bail out this bank and guarantee these bad loans just to ensure stability in their country. So think about that in our context in the Bahamas when you think about bailouts, because we have done that in our country, not necessarily with banks, we have done that with hotels. Okay. And again, you have to say, how did this happen? So the CEO resigned after the collapse, November 2008. And they note in your materially stripped of his knighthood. And after it was discovered, some of the things that were going on at the time. So again, highlighted leadership at the top, what's happening. So what do we learn from this particular case? So here the focus is on compensation. The CEO, his annual pension was £703,000, payable for life. Okay. And it became payable immediately, although, he was only 50 years old at the time. And the board was complicit in this compensation package because they allowed him to join at a certain age. And they allowed him also to choose the years to determine the figure for the pension. And they also allowed him to have the choice at the age when he would be able to take the full pension. So the board did all of that. Right? So that means that you have culture as well as governance that is not working in the best interest of the entity. Now, what does this say about the values of this company? When someone is doing well in a company, or when someone is doing, or when a company has record profits, and there are no boundaries in place in terms of compensation, what happens? Do you think, and I'll just ask this question to all of you, do you think this happens in our environment?
I could speak to being a part of a merger 18 years ago. Scotia acquired Mass Pearson. What was done is that the bad apples in terms of clients were dispelled, and whatever in our culture they didn't want, they got rid of. Because it was a conservative bank, we adapted and absorbed into what their culture was. And the culture of Mass Pearson was removed. It was a successful merger. And people were sent home. Some people were kept. And so all in all, and that is a conservative bank. So, and we did lose a lot of big clients, but the culture set by Scotia dominated and took over. So maybe looking at this situation here, Royal Bank of Scotland had a strong culture. Could it not have infiltrated ABM and sold off the bad apples and tried to rein it in? Just curious.
Well, I would say this, and you make a very good point, because I don't know if you are aware, but the Canadian banks did not suffer as badly as the American ones and in Europe
Yeah, I'm aware.
through the financial crisis, because they are more conservative. The
Yeah.
Swiss banks as well, because of their conservative nature, did not suffer as much either, right? So definitely, if you are the dominant acquirer, the entity that's being acquired, you could determine how it impacts you, and whether you take on their culture or whether you maintain yours and get rid of the elements as you described in your case, where they basically ensured that their culture and values were what the new entity that was acquired they would adopt. Now, I think that situations like this happen when you have what I call the star employee or shooting star leader in your organization, and they're making a lot of money, and people don't like to disturb that. Because when someone is making a lot of money, and that means more profits, and that means more bonuses for everyone else, although there may be concerns, people tend not to say anything about it. I think in the case that you described, one advantages probably was that Scotia was definitely the larger entity, and as well, they would have been guided by corporate values in Canada. So it wouldn't have been a deal that happened at the local level. And they would have the force of what I call their mother in Canada saying this is what's going to happen. Now, when you look at certain mergers that happen even in our country locally, you always have to be concerned if you don't have that corporate structure in place. And the hope is that the regulator, their role is to step in to say, we want to make sure that when these acquisitions happen, they happen in a way that standards of good governance are maintained, that there are boundaries put in place around something as simple as people's pension. It is always interesting sometimes when mergers, acquisitions happen, and the fallout from some of them are like people don't get pension. They decide, well, that company went away. Everyone has to apply for jobs again. A lot of, good things could happen from a merger, but also negative. People use it as a way to cleanse their companies. So one of the things highlighted in this case with the FSA, which is the regulatory authority in the UK, at that time, because it's evolved since this, observations made about them was that they didn't stand up to the pressure of the industry. They were not a strong regulator at the time, and they allowed that acquisition to happen without proper due diligence over it. So it was felt that the regulator should have had a say in that acquisition and should have been involved in whether that happened or not, right? And as noted here, it became in even the regulator culture to tick the box. So if you don't have proper due diligence, what happens is that you have a deal like that happen because they're a Dutch bank, they're coming into the UK space. And so you are saying, this is gonna negatively impact the UK taxpayers, UK market, established UK bank, we should be in this conversation, right? So nowadays, it's very difficult for this to happen. So if a bank wanted to acquire another bank, even here in the Bahamas locally, central bank is going to be in your conversation, whether you like it or not. It's not going to happen because they have to approve it. And they have to be comfortable with it. And we have had some situations, not the story like the one you told. I know of some situations locally right now where investigations are happening because one entity took over another entity's books, and there are numerous questions around clients and the clients that were taken over and they should have gotten rid of the clients, etc. So again, central bank has a role. If it's Securities Commission entity, whether it's insurance, and then we have the big entities that cross over 3 industries, like say a Kalina's in insurance, they're in banking, they're in funds, and they're in real estate. So you have to always be aware as to the regulator, do they have enough teeth to push back if they see something is going to be done that's not in the public interest? And so some view the regulator too involved, but this is where you want the regulator to be involved. Because clearly in the case of Royal Bank of Scotland, the taxpayers are really the ones who are footing the bill through the bailout. And the amount of money involved is nothing to sneeze at. It's a lot given what this particular individual was paid in compensation. And as you review numerous cases, because there are more cases in the US and in the UK, a lot of the executives didn't have to pay any of the money back. They didn't reduce their lifestyle. They got big payouts as they walked out the door. You don't hear about any of them going to jail. So they walked away scot-free at the expense of taxpayers, at the expense of people who have lost their homes, at the expense of, people who lost their jobs. So that's why this is so important. So in the EU context, they have put limits even on what someone could be compensated, whether it's board or whether it is an executive in the organization. I know even external auditing firms, when you have audits in certain jurisdictions like the EU, they also evaluate, your compensation, how much you get paid. So this idea of compensation, governance, it's very important. And some of the things about what the CEO was allowed to do was suggest that the government, the board was not effective. So most significant entities have a subcommittee on their board for compensation where this is evaluated, where they are supposed to review and document why, where, and how, come up with metrics to assess the executives in the entity, as well as ensure they are reasonable and make sense. But this is not the case in every institution, and hence the reason why even in the Bahamas, we have the government seeking to put more larger institutions under a regulator because of the impact they could have on the market if they do something unethical or they do things that are negative to investors. So this idea of compensation, values, governance is very important. And this particular case really shows us why. So there's some questions that they give you at the end of this case that I think are definitely thought-provoking. Do you believe this example of regulatory failure? So do any of you think that the regulator failed here? And should they have intervened?
I think so.
Yeah.
Yeah, I feel if a company that's being regulated fails, then that's something to do or say about the regulator.
Mm-hmm. 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 And like I said, talking about the compensation committee, they have the question here as well, should the remuneration committee, senior non-executive director and chairman of Royal Bank of Scotland have been relied on to give impartial advice on the level of compensation size of pension paid to Mr. Goodwin. Now notice that the committee, the senior person on it and chairman is a non-executive director. So we come back to that idea of an executive director. So if you had an executive director in this conversation, they might have been the person to challenge to say, hey, what you doing? Why are you doing it like this? But when you have everyone in the business actively in some way, shape, or form, there is a lack of objectivity and independence sometimes to say, okay, something is wrong. And I want to say this to all of you as well. These things don't happen. Okay, something happened today and tomorrow it goes left. These things happen over time. There's people get comfortable and it starts with small steps and then it escalates that, no, this, you know, he has earned money for us and he's a good guy and we play golf together and we have lunch together. And what is happening, you building relationship and losing objective independence in a situation. So when you look from the time when something starts to exactly when, you know, it collapses, a lot of time passes. And people, you know, in a lot of these boards, people travel together, they're friends, they live in the same neighborhood, they go, you know, if it's our community, they could go to the same church, same social events. So this is something where you're not thinking, okay, this villain is in the room. They, you know, he's not going to do anything unethical. So it's important to have, for example, the non-executive director for a purpose specifically like this to add objectivity. So some of the observations on the regulator's role and points that were made in your material, they highlight 10 points that the ABN AMRO deal should have been vetted. The impact of the subprime crisis should have been considered. So when you saw a crisis happening, if it starts in the US or whatever country, there should have been some analysis across all the entities that are regulated at the regulatory level to say, hey, we need to pay attention to this. Do we have any entities on our side that this might also impact? We need to brace our constituents. So when we go to each bank, we need to have a discussion with them as to what are you doing about subprime loans? Do you have any on your books? You can make them report and you could ask them, what are you doing to mitigate any potential losses due to the crisis? The regulator could have done that. Capital requirements. So now we have capital requirements regulations in place. This wasn't in place before, but at the time, they could have required or expected injection of capital given some of the exposure that Royal Bank of Scotland took on when they bought ABN AMRO. Misleading information given to the market. So Royal Bank of Scotland actually provided information to the market that was misleading. They were overly optimistic financial reports, and that should have been questioned. And this is where, even at the regulatory level, they have analytics departments. They should be monitoring these entities to say, okay, is this normal? If all of a sudden you shift and you are overly exceptionally profitable while everyone else is struggling, someone should be asking why. Why is that the case? Not that it has to be wrong, but you should ask why. As well, the regulator ignored some of the warnings that were raised even by internal members of Royal Bank of Scotland. So another big question actually that has been asked in the Royal Bank of Scotland case, should they have been allowed to fail? should the government have bailed them out? So that wasn't really considered because there was no analysis to give the, okay, B scenario versus the A scenario. So if we let them fail, this is the possible impact. This is how it could be done in an orderly way. That wasn't done by the regulator, by the FSA. And that is one of the points. Maybe that should have been considered. The other point was, where was the Bank of England? So the Bank of England is our equivalent to central bank. And so the question was, where were they? Although they weren't a direct regulator for this entity, they should have been involved. They should have gotten involved. And then the other thing considered was senior executives. So I mentioned already, we talk a lot about the CEO, but what about the other executives in the entity? These are large institutions. They have multiple persons at the executive level. What happened to them? Could they have spoken up? Was there an avenue for them to report directly to the regulator if they had concerns? And in the case, it does mention that some persons internally did raise red flags to say we have a problem, but they were ignored. Right? And then, what could Royal Bank of Scotland done to prevent the need for a bailout? So that's also a question. So that's similar to Lehman. Could they have taken steps early on to mitigate some of the damage instead of just, waiting for everything to collapse and I'm just hurting the industry stakeholders, all the stakeholders that were involved. So that's another thing that had to be considered. Could they have done something to prevent it? So in our current regulatory framework, and I'll speak to the Bahamas for sure, and I'm sure this has been adopted from other financial centers. The central bank requires entities to do stress testing now. And this, you can view this as a preventative measure, because what it does is says, in the event of what would you do? And you need to test it. And so the central bank, when they come into regulated entities, they actually ask them to show them the results of your stress testing. So that, looking at information like that can demonstrate that you as an entity have measures in place, preventative. You can't prevent every, you can't protect yourself from every potential negative occurrence, but at least if you put measures in place, you can minimize the impact. So they ask entities to consider potential impacts and then show, what testing have you done? So for all of these items, when you go back to regulations and you go back to certain rules that have now been put in place, a lot of these are now being addressed in new regulations that you see. I know for Securities Commission in their IFA Investments Act, they speak to things. So it is something that they just have to look at, because it's assessment of themselves as well as the entity. What is your governance? What are you allowing to take place in your entity? Is there good governance occurring? What is happening at the board level, executive management, compensation, bonuses? Do we have a mechanism if there are warnings? How do they escalate? Any questions on that? So our fourth case relates to cooperatives. And in the Bahamas, cooperatives are now under, I believe, central bank. regulation. So you have entities like the cooperative finance here that have banks that did lending and savings that in times past were not under the purview of our central bank, but they are actually now. And so before that time, they may not have had a compliance officer. They may not have had an internal audit function as well. They may not have had a mature governance structure. But given a number of matters that have come up to do with lending, the credit crisis, for sure, this particular case that's been highlighted, it speaks to the need that even these type of entities that also are involved in lending and savings, they need to have a good governance structure in place. So this cooperative group, and this is out of the UK. And so I have here the definition of a cooperative if any of you are not aware. So it's normally just association of people to meet a common economic, social, or cultural need. And they own whatever they do, they own it jointly and it's democratically controlled. So it could be a bank, it could be a food store, it could be a gas station. It just depends on what they have identified as their all in common, what they'd like to achieve. So in our environment, we have had hotel union. I think they've owned gas station or the taxi union. We have banks that are owned by teachers credit union. We have, I think, another one that is the credit union owned. So this is something practiced also in the Bahamas. And so it is alive and well in many countries. And in the case of the one highlighted here in your material, this particular cooperative group consisted of 21 directors, 5 nominated by independent societies and 15 by regional boards. And there was 1 independent non-executive director. The CEO was accountable to the board for financial and operating performance. And the group board was responsible for long-term success. So they were mandated with the vision, strategy, risk management, overseeing the CEO, setting standards for governance, and ensuring the affairs of the society and the group were adhered to, as well as the interests of the members was protected. Right? So some trouble happened. And like I said, this happened in the UK group. And it started in 2013, which was identified as their worst year in their history. And their capital fell from 8.6% to 6.9% over 1 year. And this was driven by fall in profitability of their food division, right, rising overhead. So operational activities and environment, they're losing money, losing profitability, so their capital fell. And because of that, they had to raise capital. And as a result, their stake in the ownership of the cooperative venture went to 30%. So they're no longer majority in the venture, okay, in the bank. As well, they had other losses, financial issues that occurred related to being due to their overall indebtedness and limited resources. It was difficult for them to cover its losses. So what exactly went wrong? So what they did was, and you see here again, another acquisition 2009, they took over a building society. So in the UK, a building society is like a mortgage lending type institution. And it put a lot of debt on their balance sheet, which increased its risk profile. As well, the co-op bank had to, they withdrew some of their acquisitions from branches and accounts from Lloyd's because of the capital shortfall. So where they probably had reserves, they had to cash it in and make up for some of the losses they were experiencing. So they actually reported losses of 600 million pounds, which is significant, and their credit rating was downgraded to junk. They had to be rescued. And as part of the deal to get rescued, right, this is what took their stake to 30%. And the problem with that was that the balance of that ownership, the 70%, was other financial institutions and hedge funds, which means that now the interests of the co-op to benefit the members and to ensure the interests and objectives of the members are put as a priority is not going to happen now because they only have 30% interest in the co-op bank. Okay? And subsequent to that, 2019, 2013, the bank reported losses. And they also mentioned in your case that the person at the helm, the chairman, Reverend Flowers, he didn't have a lot of banking experience. They actually mentioned that when he was interviewed for the job, it was a 60-minute interview and he was hired. And as well, in terms of their governance structure, there's a small group of people, small group of members who really didn't have experience. They list in your case that some of these persons were engineers, teachers, etc. And they were the persons who control the majority of the votes and were the persons responsible for governance. So again, they didn't have a lot of experience. So now we see things again, the theme, acquisition. So we're acquiring another entity without adequate due diligence. We have put debt on our books without understanding the risk that we've taken on. And then we have to have partners because of our decisions who don't really have the interests of our entity at heart. They have competing interests. And the last thing in terms of governance is that you can have persons on the board, you can have leadership, but are they competent? And competent doesn't mean they may be qualified in the area that they operate, but are they qualified in the area that you need them to be in this case, in terms of financial institutions, do they have knowledge on how to run a banking entity? And that is critical, right? So this is something that used to happen as well in the Bahamas many long years ago. When I started out, you would go, and when I go on external audits of institutions, even local institutions, non-banks, and you see who's on the board, some of the persons on the board have no financial, experience in financial services at all. And you wonder how they got on the board. And sometimes they're on the board because they are a family member. Sometimes they're on the board because they have significant shareholding. But in terms of actual expertise in the business, very little to none, right? And that could be a problem because clearly here it would have been advantageous for the co-op to have persons on the board who can make decisions. For example, the one to take over the building society, make better decisions regarding the entity, and that impacted them, significantly down the road. So governance as well, that you can have the structure, but are the right people in the chairs. So some of the things, some of the questions to consider that were highlighted in your material, the lack of capital. Do you think that really was the issue with this co-op group? Or do you think it was poor diligence? Or was it the new chairman, right? They got this guy. Do you think, which one of these do you think was really at the core of the issues that they faced?
If there was someone that had the experience when the acquisitions came up, at least someone would have, researched the company before acquiring them.
Mm-hmm.
The total inexperience of the board members and the executive would have contributed heavily.
Mm-hmm. Mm-hmm. So think about some of our boards in our country.
Yeah, I can leave that.
Yeah, leave that. So I always smile when I see board appointments, because I actually ask some of my colleagues when persons ask them, oh, you want to be on this board? And I say, I hope you know what you're doing, because it could be, if that's not your area, then you could do a lot more harm than good. And, of course, you're compensated if depending on the entity, but you want to ensure that you are competent for the role and you are not really harming that entity. We have had failures in the Bahamas. We had Clico, we have City Market, right? And they didn't happen just because someone, one person did something that was governance. And the question is, who was on the board? Who was minding the shop? Were they competent? And the impact to our citizens, the impact to staff, employees, and then all the businesses connected to them. It's important to be aware that if if this is not something that you're familiar with, then sometimes you need to think about, should I participate or should I serve? Am I qualified to do that? And if you were asked to advise the group board of the co-op group on its governance arrangements, what would you propose? So what do you think they could have done differently in terms of their governance arrangements? Do you think they should have had a vetting process for board members? They could have had committees set up for acquisitions where a board committee would specifically look at it, and they could have invited someone to give them advice on from the financial sector. They could have asked the regulator to give input on it before they undertook the acquisition. So there are things that they could have done in terms of some recommendations that they highlight in your material. One was produce a competent and qualified group board with independent, non-executive directors with skills and experience to lead and oversee complex business. You know, so that is skills and experience. The second thing they recommended was that the values and principles of the cooperative, you want to make sure that when you establish a governance structure, that it's embedded in that structure to ensure that is protected. So the purpose of your organization, you stay true to that if that is understood and if that is embedded in the governance architecture. So that could look like if we take a decision, if it's going to cause our interests or us to move away from what our goals and objectives are as a cooperative, we will not accept it. And they could have that embedded, they could put that in policy, they could put that in their board mandates. So in their board policy, and that could guide decision-making so that if something opportunity exists, they cannot pursue it if it will contradict or be in conflict with the goals of the cooperative. And then the last thing that was mentioned here, ensure customer, that it has a customer-owned organization and protect the membership. So that point was more around where, you know, when you have, as part of the governance structure, the impact is to the entire organization, and in the instance of the cooperative, all of the members. So a good governance structure is going to ensure transparency. It's going to ensure that all stakeholders are protected and are considered. So in your text, they go on to add a few more points, and I encourage you to review it. But these are things to consider again going back to a governance structure, the role of the board, who are the board members, are they qualified to serve? Are you properly capitalized? When you make major decisions, is there a process to vet them? What is the role of the regulator? And really you should be partnering with the regulator to make sure that whatever you're doing, right, doesn't contravene good governance, as well as it makes sense for your business. So we have another case here, social responsibility. So we are out of the, so this one is a little bit away from financial services, and this actually involves Apple computers and a subcontractor, Foxconn. Okay. So I think everyone knows Apple computer, Apple phones, etc. So I don't really have to go over the history of that. They talk about it at length in your material. But what is important to note about Apple is that a lot of their manufacturing doesn't occur in the US, but in overseas locations in Asia and mainland China. And the advantages, of course, are huge for Apple because they're able to minimize costs, and they are also able to, through supply chain, be able to create a whole industrial sector. And through this process, they have reduced the production cost of iPhone to 47% of the cost of production in the United States. Now, there's a side to this, another side to this, because, you know, you have to understand how is this possible. So one of their subcontractors, so that's one of the production facilities they use, and they use subcontractors for different purposes. So one maintains dormitories on factory grounds, so that's Foxconn. And they allowed, what they do is they allow the immediate mobilizations of 1,000 workers. And that is they can get the workers you need and also have them in place depending on demands of the assembly line. If the demand changes, they can mobilize these workers right away, okay? And because of the scale of the contracts offered by Apple, Apple has a lot of influence over these contractors and the practices and how they treat their workers. So you have this relationship between the actual provider, that's Apple, and the subcontractors they use. So this one in particular is the one that mobilizes workers. They probably have a different one to actually manufacture. They may have a different one for distribution, but they use this system of subcontractors to get it done and get that phone to you in your hand, right? At the cost that, you know, that would be profitable to them. So what happened in this instance? So this is where we are looking at corporate social responsibility. So Foxconn, the subcontractor, came up on the radar because there were some people that visited the iPod factory in China, and this appeared in the media. So this happened in 2006. And when they visited, they observed poor working conditions, low wages, and they saw as well there was forced overtime. Apple itself, after this came out in the media, also uncovered 106 cases at that time of child labor in the year after the revelations, okay? So notice, not until 2012, Foxconn, the subcontractor itself, admitted to using child labor. And they admitted that they targeted internships at school, you know, school students who were below legal minimum working age. They paid them $244 a month. They compelled them to work overtime until the tasks were completed. And some of the young people were as young as 14 years. As well, in 2010, they were exposed for overworking employees to the point of suicide. And in that year, it was reported 17 suicide attempts and 13 were successful, okay? So we have here an example of where Apple is not being socially responsible, neither is Foxconn, okay? Both are a part of this problem. So how did Apple respond? So it's come out in the media. They have to deal with it. They don't want this negative publicity. They want to be seen as socially responsible, right? So they come out with a supplier code of conduct where they set expectations for anyone that deals with them overseas, the type of conduct that they expect. They also have audits done, and the results of those audits are published on their website. They also insist on worker and management training. They insist on elimination of safety hazards, overtime, child labor, and elimination of child labor in subcontractors' factories. And then the last thing here, third-party oversight. So they ask other groups outside of them to go in and confirm compliance, that the subcontractors are doing as they are supposed to, right? So these could be watchdog groups that go and check and do their own investigations and surveillance to make sure that nothing is happening under the radar. So here are some of the questions in your material they ask us to consider. is how accountable do you think Apple was in these situations? Do you think they were accountable? Do you think they have responsibility?
Michael.
Oops, I think someone has to mute. Sorry. Any thoughts on this?
Well, I definitely think they have some responsibility.
Mm-hmm. That is Apple, yeah? Suppose you were someone doing business with Apple, your company was doing business with Apple, how would you feel about this?
Definitely a reputational risk.
Yeah, agreed.
So I guess they'll have to deal with the problem efficiently to avoid losses.
So a question I have for all of you, what do you think the impact, how do you think social media has impacted these sort of things in terms of social responsibility?
For me, I feel that social media, when you look at companies such as Apple, ensures more transparency because now they know that the whole global world or network is looking at them more intensely, if I may say. And so they, some of them, I should say, some of these companies may now introduce or implement, what is the word?
It's corporate
Implement,
social responsibility policy, like a code of conduct.
right. Okay, that's my 2 cents.
So do you think this is something we in the Bahamas should care about?
Yes. I think the social media platform for our banks or our cooperatives, because it can impact our market so negatively, I think that more policies should be introduced in terms of the social media platform, how directors or employees conduct themselves and how they do business.
So think about it, our number one industry is tourism. And if it's determined, or a person say, well, don't go to the Bahamas because they have children who are underage who are working, similar to this. So you shouldn't go to any of the hotels in the Bahamas, support them because they are not socially responsible and they are using child labor. You could apply this to the environment, that they don't have adequate policies around, plastics, all this other business. So social responsibility, keep in mind, one part of it could be, child labor laws. Another part of it could be the environment, So it's something else to consider if you are in compliance and if you are serving on the board in terms of governance. You would want to know, is there a policy regarding corporate social responsibility? Is that a part of, your policy? Is there a policy around plastic? We have a policy around plastic countrywide, but at a company level, is there a policy? Is there a policy regarding, how we treat our staff, or code of conduct? All those things are important because it speaks to the company. And clearly Apple, because of investigations that were done, not by them initially, but stories that came out that negatively impacted their company. And this had nothing to do with the quality of their product. It didn't have anything to do with service delivery. It didn't have anything to do with their innovation. Clearly, people had issues with how, the product was made and the conditions, and that they were using child labor and there were people being harmed. So it gives us something to consider about corporate social responsibility, and how does that tie into our governance structure, and is it being considered at the board level? Is it being considered in our corporate governance framework? It is important, and it's something that if it's not being considered in your organization, something to make sure that there's awareness and people understand what that means. Yeah, because you being socially responsible, like I said, could have many pieces to it, but definitely awareness is the first piece that's important. So this is an area that is emerging. I don't think people have paid attention to it as much in the past. Definitely in the US, it's huge, from racial equality to gender equality to ensuring that everyone has equal opportunity, equal pay, all those type of things. That's also social responsibility to the climate, climate issues, again, child labor, using foreign labor as well. That's a big issue. I think that's still a big issue in our country, undocumented people working and under the radar and being, if they are being mistreated, etc. So all of these things can impact a company's success as well as reputation, as was already mentioned. So something to consider when you are looking at your governance structure. And the last case that we're going to look at, and this is a short, go ahead.
I just want to say, in the past, I think with most of the financial institutions, social responsibility was ensuring that a charitable organization got a check.
Mm-hmm.
And they felt they did, give a couple checks to a couple charitable institutions, and we've done our social responsibility, but it's beyond that now.
It is beyond that. I will tell you, I went to a training, this may have been 3 or 4 years ago in Canada, and their social responsibility goes as far as if you are in Toronto area, if you are in a high rise, if you're in certain buildings, your lease payment for your floor, all of that will be lower. If your staff does not use any type of, what I'd say, definitely no plastic, if they use reusable containers, if all the lights go out by a certain time. So any of the energy efficient things that you could do in a building, if you do them in your, on your floor, or in the spaces you rent, you get concessions. And they have what they call is, I can't remember if they call it a green policy for downtown Toronto, but their incentives they give to companies for, adopting these practices, and they're highlighted and they're put on a list and all of this stuff, so that people, even when they're doing their purchases, when they're doing business, they know that these companies are a part of that process. So they are very advanced in how they look at, corporate responsibility. You have in some companies in the US diversity officers, right? To deal with issues of race, of gender equality. So you have not just, I know in the Bahamas, it's a lot of the focus is on now help, what they call the reporting, where you could anonymously report tip lines to say if something is wrong or there's a breach. But as well, in a lot of companies in the US, they have avenues beyond that for, diversity training. And they say that we are, companies actually say we hire so many minorities, we hire so many young people, we hire so many women, and that is part of their corporate goals and objectives. And they make sure that's evident at the board, at every level of the company. So being socially responsible is something that I think is still new to us in the Bahamas, but it's something that we have to be even more aware of. I don't know if any of you watched the debate last night, but one interesting point was from one of the commentators was that the agreements that the Bahamas signed on to, well, I'm not certain if the Bahamas signed on to it, but the G7 countries signed onto was that by 2050, there'll be zero reliance on these fossil fuels. And I thought that was interesting because I said, well, I wonder what we are doing locally to make sure that we could be compliant, because once the bigger countries shut down, we are done if we are not, working in tandem with what is happening in the wider environment. So I think this is something we have to pay attention to. So I definitely would say, if it's not something you're talking about now, it's something to think about. So our last case, McKinsey & Co. McKinsey is a large US management consulting firm, a law firm, but their focus was on bankruptcy cases. And they were actually accused of, in 2018, of misleading bankruptcy courts over conflicts of interest where they had been appointed bankruptcy consultant. And it was alleged that the firm, they did not declare all their connections, right? And if they had declared it, they would have been unable to work on the cases that they did. They also were accused of offering incentives to attorneys in exchange for bankruptcy clients. And also was highlighted their lack of independence, that their ties to other parties created conflicts of interest. So here, again, you are appointed in some cases. In this case, you're appointed to be a bankruptcy consultant. And in our local context, it could be a situation where you are appointed receiver in a liquidation matter. And so you are held to a certain standard. You should not have any conflicts of interest. This should be disclosed. And they give, I highlight two of the examples for the allegations that were levied against them, that they sought creditors' approval of a restructure plan where most of the assets were to be sold to other companies, some of whom McKinsey were McKinsey clients. So clearly you can't be working for both sides. You propose a restructuring plan, you're approving it, and you're gonna make sure you approve it in the interest of your own clients. And then 2018 is reported that they failed to disclose financial interest in the outcome of 6 cases where they were serving a specialist advisor, which in the case of the US was a violation of bankruptcy laws. So here we need to make sure in our businesses, we we follow the rules, we follow the law, that we disclose any conflicts before they arise, and that if there's an issue and we are uncertain, that we bring it to the level of the board and management so that it could be clear where we stand. Now, of course, in matters like this, the question is always, was the board aware? Were they complicit? But again, this highlights the need of education and awareness in our entities to make sure that persons understand, you know, what the rules are, what are the consequences, and to make sure that we disclose if we are unsure, and we seek advice to make sure that we are proceeding in a manner that is legal and lawful. The risk, of course, you could have, you know, liability as well. You go to jail, financial penalty and fines, as well as reputational damage. But I would say that you start at the level of awareness to make sure that everyone is aware of what their role is, what a conflict looks like, and as well, if you do have a conflict, to disclose it so that it could be addressed and determined if the service could be provided. So at the board level, and I will tie this into what we are doing here in terms of corporate governance, risk and compliance. So if you serve outside of the level of the board, if you serve at the level of the board, you are normally asked, if you're in a well-regulated institution, to complete a questionnaire, and you are to confirm your interests if you serve as director on any other institutions, if you have financial interests, and as well confirm you have no conflicts. If you have any conflicts or you think that you may have a conflict, you are to disclose it. In the forms that you complete, if you want to be a director on a company, well, an entity that's regulated by central bank or by Securities Commission, they also, on their form, you have to disclose, you have to disclose roles that you hold outside of that company. So if you serve as director, officer, or any other role you serve on, because in their own vetting process as a regulator, they do assess any conflicts of interest. So in the event that is determined you didn't disclose, you could have a lot of problems, okay? And I think that people assume that in a small country like ours, it is, you know, it's hard to say, well, you didn't know, whatever, but a lot of people use companies and other corporate vehicles to hide ownership, to hide associations as well. People tend to have interests in a way. They may do it through their children or through third parties, but it's important to make sure, no matter what, that we are disclosing any conflicts as they arise. So that was the thing there. So some other noteworthy items I wanted to highlight from the cases. So when you review these cases, the thing that I want you to take away is that the cases show us why these things happen. Where were the gaps, the missteps? So when you look at these cases, it's important not just to read through, okay, this happened, what have you, but it's important to understand why it occurred. And some of the reasons are not always obvious right away. And as we saw from one of the cases, we could blame the environment, but it might be something deeper in terms of leadership, the governance structure, training, competence, the way the company was structured, the lack of corporate governance framework, lack of policy. So there's a reason, okay? Because there are companies that didn't fall, didn't collapse, aren't being sued. What are they doing differently? The second thing that I think that is important for you to take away is the consequences of one. So in the first one, what are the consequences of not doing it correctly? And why we should do it differently. So looking at the cases gives us support of why we should do it differently. In your own assignments where you have the long cases, oftentimes you have to make recommendations, and it's important for you to be able to support why you're making a recommendation. And it's very effective to use cases to support why they need to take a particular course of action. If I tell my institution, hey, you shouldn't go down this road, and they say, well, you're saying that, but nothing's gonna happen. I said, well, you know, bank number 2 down the road went down this road, and I could tell you this is what the consequences. So you don't wanna be on that list. And then they pay attention because they don't wanna be on the list, or they don't wanna be fined because they realize that there are consequences, that something actually happened. So that's the other reason the cases are really good, because they highlight where there were consequences, someone got fined, institution collapsed, reputational issues. So that's the other thing that we get from the cases. And the last point I would say is that it provides us with lessons learned. What do we need to avoid? As well, how do we protect our organizations from similar peril? So what do we need to do to protect? Once we highlight what was missing, they are the clues to what we need to put in place to protect our organizations. So it must be a lesson learned, or else we will repeat the same mistakes as we saw in a number of those cases. If we have a high flyer in the organization who, you know, generates a lot of profit, that might be a good thing, but maybe we need to investigate further. Why is that the case? How come you make more money, so much more than everyone else? What are you doing differently, right? That's a lesson learned. We need to investigate. We need to be comfortable with their methods. We need to be comfortable with their approach. So from this, I think, if nothing else, the takeaway should be the why, the consequences thereof, and what are the lessons that we could learn from it. And definitely all of those could be used in your assignments and cases going forward. Any questions from that material? That's the end of Unit 6, Situations and Cases. I believe I am supposed to, in another class, supposed to go over your assignment. If someone could tell me what date that is due.
I think it's due July 12th.
Okay. All right. All right, I think they're gonna send me a copy of it, but it's supposed to go over your assignment. Has everyone started it?
Doing research.
Okay. So if you haven't started, I would say start as soon as possible, do an outline. I'm gonna see if that is the next class, but I would say start with an outline, do some work on it. So when we do speak about it, you would have gone through it and did some initial work and have an approach. So when we talk about it, it could be useful. Any other questions, concerns about the material? I hope that was useful to your exercise.
Jackie, I have a question.
Yes.
The cases that we just reviewed, are you allowed to cite them?
Yes, you can, as far as I'm aware. Once you cite your source, there are multiple sources for some of those cases because there are different analysis that have been done. So once you cite your source, you could you should be using them as support.
Okay, thank you.
Even if you're not using that jurisdiction, based
Even
on
if you-
your answer, the direction of your answer to your question, to the question.
Even if it's not in your jurisdiction, it's still relevant because it supports the need. Because something hasn't happened here doesn't mean it cannot. And so it supports the need to put it in place here locally if it prevents the same sort of behavior or event from happening in your organization here. So definitely will support what you're doing if it's relevant to your matter. I wouldn't advocate putting cases for the sake of it, but if it supports your point why good governance is important, and say it's related to board performances, board compensation, and you use Royal Bank of Scotland as an example, and how, when it is not monitored, how it could negatively impact all stakeholders. Well, yeah, that's a good argument for that. Enron is another good example of where that happened. Lehman, another one, where, compensation wasn't monitored, and the EU put in their EU directives specific guidance around compensation just because of that. So definitely use the cases to support your points. And even if you don't use it directly, just if you say, well, I don't really want to cite it, I think you could still use it to help you develop points in your case. So if I had a case and I wanted to understand where are the gaps, at least I have a real life example to say, these are the areas that were gaps that were identified. Do I see any of these in the case that they gave me? And that's a way to use a case as well to help you with yours. So if I had a case on governance and we have a real life case that happened and they said, well, they need an independent director, that was lacking. Does my case have an independent director, non-executive? If it doesn't, then that's a point I could make. If it has, if the composition was not evaluated and I had people in my case and they don't have qualifications in this area, that's a point because that was highlighted in one of the cases that I saw. So that's another way you could use the case to help you at least find and identify all the issues with a particular entity. Any other questions? So that's it for us tonight. I'm going to check the schedule. I'm not sure if it's the next class. I may have the assignment, but I'll see. But everyone have a good evening and stay safe. I know it's raining outside if you're not at home. But have a good evening.
Good evening.
Good evening.
Good evening.
Good evening.